quite a timely morning for you to be with us, given, of course, now the jump in commodities prices as well. I guess this all plays into the inflationary picture, not to mention the Fed rate path.
Well, thank you for having me in the morning. As you said, the geopolitical risks are still there, and the investors will continue to cope with the volatilities coming from the conflict in Ukraine, also a bit of tension between U.S. and China. So we are starting the new year on a relatively defensive setting. And we still think 2023 will be the year of consequential pivots in global monetary policy, macroeconomic data, and financial markets. As you said, the one factor that we're paranoid about is the possibility of disruption in the food supply, because that will be pretty impactful for all economies, especially on the emerging market side. So far, the latest that we have, despite what you have seen in Poland, is that this grain corridor deal is still holding and it's being extended. So that's good news. And assuming that this is maintained, we can maybe avoid significant disruption for the markets, as far as the food and inflation picture is concerned. But that's going to be a risk factor we'll be watching. But overall, in 2023, the likely picture will be peaking rates, stabilizing inflation, and a shift in the market sentiment, starting with the currency markets and fixed income markets. We still need to get there first. So it's going to be a bumpy road due to the geopolitical risk and the recession risks. But 6 to 9 months from now, the tone of conversation we'll be having about markets will be quite different.
It's really interesting that you talk about the currency markets, because we have seen the dollar break lower, as this chart on the Bloomberg shows. And even with these geopolitical tensions, it's not really jumping or moving higher at the moment.
So it's due to relatively benign inflation data from October in the U.S. The market really seemed to be moving toward kind of a peaking rate outlook for the U.S. as we head into 2023. Keep in mind that in recession episodes, usually you have this period where falling inflation and weakening economic data actually motivate a bit of safe haven demand for the dollar. So we don't think the dollar trend has completely reversed yet. We do see some scope for dollar to strengthen, especially against the European currencies. So we do maintain some selective longs on dollar versus some of the European currencies. But obviously, the magnitude of the rally in the dollar that we have seen this year is incredible. It's unlikely to be repeated next year. So in the near term, we see some scope for dollar strength, but in the medium term, we do see the possibility that basically the dollar strength peters out, or actually have a bit of a reversal in the dollar's strength, maybe by the end of 2023.
Homin, you talk about liking global value trades. I'm wondering if that extends to China, because that's also a market that you're quite constructive on. But take a look at this chart, looking at the exponential growth that we've seen in COVID-19 cases. We could actually see cases hitting 20,000 in the next day or so. And at the same time, we still see the property sector really beleaguered, 14 straight months of decline seen for new home prices. And that is still a sector in crisis. So what is a catalyst then going forward for China?
Well, the market reaction in past few days make it clear that the markets like the message from Beijing, and we do believe the journey toward reopening has begun. Now, it's not going to be in a straight line going forward. It will involve some trial and error, as we have seen in other countries that have reopened recently. But the direction is pretty clear at this juncture. And of course, we're talking about a market that has been quite depressed. Despite the rally they have seen in past few days, the valuation of the Chinese market is still quite depressed against the other markets. So In our view, this value trade will still, work. Chinese authorities have complete initiative against the market in terms of releasing new guidance on vaccines or PCR testing. So in the near term, we're still quite positive, and therefore we have some overweight in China versus the broader emerging markets. And as far as the global value story is concerned, it is true that we're dealing with some economic cycle risk, but we do believe investors will rely more on dividend styles and a value factor as opposed to promise of growth in the future, given the challenging macro and policy picture. So that's a factor that we're keen to have in the portfolio, and we do have some overweight exposures to that style.
Japan, mid-caps are also a favorite for next year.
So for our Japanese allocation, we're actually trying to be a bit more creative here. You've seen probably in the Bloomberg consensus numbers, Japan is expected to outperform almost all other developed markets in 2023. And this happens to be our view as well. It's a country that's benefiting from belated reopening, potential boost from tourism sector, less disruption on the energy front, and policy support on fiscal and monetary fronts. And of course, weak yen and friendshoring trends are helping the capex activities there. So we do think the country will benefit from pretty strong domestic demand. And one way to benefit from that would be to focus on universe of companies that benefit from domestic demand, and that will be small mid-cap style in Japan.